Marsden, Queensland, in the Logan corridor. Median house price right now, $937,000. Median rent, $550 a week. That's a gross yield of 3.05%. It would take the median household 60 years of income to pay off the median home. Every buyer's agent in this country is still pitching their clients into Logan. And here's the thing, even if I told you not to buy Logan, and I'm about to, the suburb level data I just gave you is the wrong number to be looking at. In this video, I'm going to show you why. I'm also going to show you a specific orange property that sold last week for $650,000 and is yielding 4.3%. I'm going to show you Footscray units returning 6%. And I'm going to teach you the one investing concept that separates retail investors from professionals. Markets within markets. I'm Sean and I run PropSpotter. We do three things and only three things. We research every suburb in Australia through 30 plus institutional data sources, the same data the banks and developers use, pointed at retail investors. We source proprietary listing alerts and off-market pipelines that surface deals you'll never find on Domain. And we coach, fixed fee, sit on WhatsApp with you, coaching for the entire purchase. Over 50 investors, 5-star Google rating across the board. We're not buyer's agents. We don't take percentages. We give you the playbook and we walk it with you. Before the 2026 budget, you could buy almost any decent looking property in a growth corridor. Run it at a 15 grand a year loss and let negative gearing claw 3,000 or 4,000 back at tax time. The cash flow gap was bearable because the tax man was your silent partner. From 1 July 2027, that partnership is over. Any established property you buy from this point onwards, you wear the full cash flow gap, which means the question of where you buy and more importantly, what segment of the suburb you buy in just became the most important decision in your investing lifetime. Here's the concept that's going to change how you look at it every single suburb in Australia. It's called markets within markets. When you look at a property report and you see orange median house price of $827,000, that number is almost useless because that median is being pulled up by 4-bedroom McMansions out near the golf course that sell to local doctors and farm sale retirees. What you, as an investor, actually want to buy in orange is a 2 or 3-bedroom cottage on a 500 to 1,000 square meter block in the older inner streets. And in May 2026, those cottages are sitting between $550,000 to $700,000. Same suburb, completely different price point, completely different yield. This is the single biggest difference between a professional investor and a retail one. The retail investor reads the top line suburb median and decides yes or no. The professional reads the median, ignores it, and then asks the next question: which segment, at which price point, and which yield? 3 numbers we use to evaluate every segment. Number 1, gross yield. With negative gearing gone, your rent has to do the heavy lifting. Number 2, years to own. How affordable is the entry point? Because affordability is the ceiling on capital growth. And number 3, the growth cycle position. Is this market at the start of a price phase, at the peak, or on the way down? Apply those numbers to every segment of every suburb and the deals reveal themselves. Let me show you. Logan, Southeast Brisbane. For 3 years straight, a fair few people are still pitching this corridor even in 2026. Affordable entry, Brisbane growth story, ride the boom. Here's the data right now. Marsden median house, $937,000. Yield, 3.05%. 60.7 years to own the median home. Beenleigh, not far behind, 908,000, yield 3.3%, 56.9 years. Logan Central, 878, yield 3.45%, 74.8 years to pay off the median house. 74 years. Now, you might think, okay, well, what if I apply your markets within markets logic to Logan? Surely the cheaper 3-bedroom cottages must yield better. They don't. 3-bedroom Marsden, 887 at 3.38. 3-bedroom Beenleigh, 868 at 3.49. The entire suburb is broken at every segment. The bottom isn't where Logan's gone wrong. Logan has gone wrong all the way through. Run the math at $900,000. 80% loan at 6.2%, $44,600 a year in interest. $8 grand for rates, insurance, management, maintenance, $52.5 in holding costs. Rent brings in $30,000. You're $22.5 grand a year in the hole. Pre-budget, you'd have got 8 or 9 grand back of that from the tax man. Post-budget, you get nothing. $22,500 of cash every year fed into an asset whose entire cycle is now classified as decreasing by every major data provider in the country, including ours. I personally would not be buying anywhere in Logan today. I do not care which buyer's agent or selling agent is telling you otherwise. Now let me show you what the markets within markets framework looks like applied properly. Orange, New South Wales, regional centre, 250 k's west of Sydney, 40,000 people, diversified economy. Health, education, government agriculture, wine, not a mining town. Suburb median, $827,000. Yield, 3.57%. If you stop there, you'd conclude Orange is no better than Logan and you'd walk away. Now, let's peel it back. 2-bedroom houses in Orange, median 585, rent of 483 with a gross yield of 4.29%. 3-bedroom houses, 712,000, rent 550, yield 4.01%. Units, 496, gross yield 4.85%. Same suburb, 3 different markets. Let me get specific. 85 Autumn Street, Orange, 3-bedroom, 1-bath cottage on a 1,000 square meter block in the inner ring. Sold on the 7th of May, 2026, which is right before we started filming this. Sale price, $650,000. Our data says the rent on it is $540 a week. Plug those numbers in, annualized rent of $28,000 on a purchase price of $650. That is a gross yield of 4.32. Years to own that specific property, 41. Compare that against Logan. $287,000 cheaper to buy than the Marsden median, a 1.3 percentage point better yield, nearly 20 years better on the affordability ceiling, same money, different suburb, completely different investment outcome. And 85 Autumn Street is not a unicorn. It's the segment median. There are dozens of properties like this across Orange right now. There are dozens like it in Dubbo where the same pattern holds. Honest caveat, Orange and Dubbo are both classified as peak in this growth rate cycle. They've run hard the last 5 years. Forward looking, you should expect 0 to modest capital growth, not the rocket ship returns of 2020 to 2023. However, what you're buying here is a quality, low risk, high yield asset at fair value, where the yield carries the deal and any capital growth is upside. That is a foundation property purchase for a first or second investment property. That is exactly the right profile. Now the standout, Footscray, Melbourne. Inner West, 6 k's from the CBD. The unit market in Footscray has been considered radioactive since the 2017 apartment oversupply event. While Melbourne housing has run sideways and then up, Footscray units have done basically nothing. Prices have been flat for nearly 5 years. But here's what's happening underneath. While unit prices stayed flat, rents kept climbing. 5 years of rental growth on an asset whose capital price hasn't moved has created the cleanest yield distortion in metropolitan Australia right now. 2-bedroom units in Footscray today, median price $487, median rent $570 a week, gross yield 6.1%. After strata fees, call it $3,500 a year in a well-managed building, you're at a net yield of around 5.4%, cash flow positive from year 1, even at today's interest rates. But the yield's only half the story. Footscray units are the most affordable asset in this video. 22 years to own, the lowest figure of anything I've looked at today. That means demand support is structurally underneath you. The growth rate cycle is classified as increasing, early phase. While Logan is decreasing and Orange and Dubbo are at their peak, Footscray units are at the start of a growth phase, and the volatility index is 3 out of 10, the lowest of every asset we've discussed. Now, the catch. You have to read the strata report. Special levies on a poorly run unit building can be a 6-figure surprise. You have to check the building's defect history, the sinking fund balance, the owner's corporation governance. This is exactly where the source pillar of our model matters most. Finding the right unit at the right yield is the easy part. Finding the right building is the part most retail investors get wrong. Pick the wrong building and your 6% yield becomes a 3% yield the day you cop a $40,000 special levy. Pick the right building and you have the cleanest cash flow positive inner city investment in Australia in May 2026. This same dynamic we're talking about now exists in pockets of Coburg, Brunswick, parts of Carlton, parts of Box Hill. Anywhere unit prices stayed flat through a rental boom and the underlying suburb has growing rental demand. You hunt for that intersection. So now you know where to look at. Let's talk briefly about who buys it. Quick disclaimer, I'm not your accountant. None of this is personal, financial, tax, or legal advice. Talk to your specific professional before you do anything. For almost every retail investor I work with, the answer is personal name. Not a trust, not a company, personal name. The question becomes, whose personal name? Single income earner, you don't really have a choice. It's you. Asset selection has to do all the work, which is exactly why we spent the last 8 minutes on it. Couple, the math has flipped post-budget. Pre-budget, you'd buy in the higher owner's name to maximize the negative gearing rebate. Post-budget, that rebate is gone for established property. The lower earning spouse now becomes the more efficient owner because when the property turns cash flow positive down the track, the rental income is taxed at his or her lower marginal rate. And when you eventually sell, the capital gain under the new indexation method gets taxed at the lower rate too. Trade-off. This person may have lower borrowing capacity. Sometimes you'll need joint names. That call belongs with your mortgage broker and accountant. Two more quick mentions. SMSF, long horizon, you can live with the rules. Self-managed super may just be one of the most tax-efficient property structures in Australia because SMSFs are explicitly carved out of the negative gearing changes. Discretionary trusts, after the 30% trustee minimum tax kicks in from July 2028, they are no longer tax efficient for new property purchases. Still useful for asset protection, not useful for tax. Don't let an old school accountant talk you into one without showing you the post-budget math first. That's the playbook. Logan avoid. The entire suburb is broken. Orange and Dubbo, markets within markets, shop the segment, not the headline. Footscray units, the cleanest cash flow positive inner city play in Australia right now. If you want help applying this framework to your borrowing capacity, your timeline, and your specific shortlist, that's what we do at PropSpotter. Go to propspotter.com.au, book a call, and if we can help, we'll tell you. If we can't, we'll tell you. One-on-one coaching, reputation depends on results. The 2026 budget did not kill property investing. It killed the version of property investing where you could be lazy about the data and let negative gearing save your ass. The next decade belongs to investors who can read the data, who can tell the difference between a Marsden and an Orange, who can tell the difference between a suburb median and a segment median. Markets within markets, that's the whole game now. I'll see you in the next one.